In this video, we are still discussing an introduction to real estate investing fundamentals and strategies. I'm Donna S. Robinson, the Director of Realty Biz Consulting. And today, in this video, we're talking about market fundamentals. We've already discussed property fundamentals. You might want to refer to that video if you haven't already watched it. Basically, there are two main types of fundamentals related to real estate and real estate investing. The first one that we've already discussed is property fundamentals, and in this video we're discussing market fundamentals. Now, as you can see, market fundamentals involve the bigger overarching fundamentals that also have an impact on real estate, on real property, and investing in real property. What happens is when the market fundamentals change, the strategies have to change to suit the fundamentals. Remember, in the first two videos we discussed the fact that fundamentals dictate strategy. When fundamentals change, strategy generally has to change with it in order to ensure that you continue to have success as a real estate investor. In fact, this is one of the classic problems that you never see addressed in a typical real estate seminar. When fundamentals change, the seminar topic, the strategy that's involved in most seminars, are on a specific strategy. When the fundamentals change, that strategy can stop working. And we've seen that repeatedly over the years. I mentioned in the previous video on strategies several specific examples of major high-profile investors and problems that they had with the market when the fundamentals changed. Interest rates is one of the biggest of the market fundamentals. Today we have very low interest rates, but we've also had, as you'll see in just a moment, very high interest rates. And they have a direct impact on the way that real estate investing strategies play out. Employment and unemployment is another major fundamental that's having a huge impact on the real estate market today. As we know, the sudden increase in unemployment brought on by the housing market meltdown, the credit market meltdown, and so forth, created tons of unemployment, very high unemployment rate, and that resulted in millions of new foreclosures. That entire process completely changed the fundamentals of the real estate market for investing purposes. Average rent rates for an area are fundamental to a specific area. For example, a two-bedroom, one-bath house in California in a coastal area might rent for $2,000 a month. That same property located in Atlanta, Georgia would rent for something like $750. So rent rates vary dramatically based on the particular area where the property is located, but rent rates are fundamental to that area because you can't arbitrarily raise rent rates to cover your property ownership cost. So you have to make sure that you understand what your rental rate is before you buy a property, and that has a direct impact on what you could afford to pay for that property. Vacancy rates are fundamental because you have to deal with vacancy rates. All properties are going to be, rental properties in particular, are going to be vacant at some point in time. And the question that a real estate investor has to ask is, how often will a given property be vacant, and therefore that has an impact on your cash flow. For example, a typical single-family rental property with a typical 6-month to 1-year lease is going to be vacant an average of once to twice a year, and that's typically going to be roughly a 30-day cycle. Again, these things vary depending on location, type of property, and so forth. So a vacancy rate in a single-family property might run something out of 1 month in 12 or 2 months in 12. On the other hand, a vacancy rate for a condo at the beach that you own, but you rent out to other vacationers to come and stay at the beach, you might have a vacancy rate as high as 60%, because condos have a lot of activity when they're in season and very little activity when that area is out of season. So vacancy rates vary dramatically depending on the type of property that you're renting. Inventory available is another big market variable. The more inventory you have, the more supply you have of available properties, the lower prices are going to be. This is why we are seeing prices still dropping today in cities like Atlanta, Las Vegas, Chicago, and areas that were hard hit by the foreclosure crisis. These areas have lots of new foreclosures, and or maybe they were overbuilt too with new homes. And subdivisions in the Atlanta area where I'm located, we have entire subdivisions that were foreclosed on, and we have hundreds of those because Atlanta has a very large metro area. So one of the main reasons that prices are lower in Atlanta on average than most other cities is because we have a tremendous amount of inventory available relative to the demand for that inventory. The loan-to-value ratio, LTV stands for loan-to-value ratio, on existing mortgages is also a fundamental issue, because when you want to take over an existing mortgage as part of your investment strategy, this is something commonly called subject to the existing mortgage, the amount that the current seller owes for that property versus what that property is worth is the loan-to-value ratio. For example, if a owner had a property that is worth $100,000 and they owe $50,000 on their mortgage, their loan-to-value ratio would be 50%. Today, though, what we're seeing is more commonly folks who are underwater, so to speak. So it's the reverse. Their property is worth, say, $50,000, but they may owe $100,000 on that property. Therefore, their loan-to-value ratio is upside down. In a case like that, you would not want to take over that existing mortgage, but rather a short sale might be in order if that seller is delinquent on their payments. So moving on, we're going to look at some actual market data and show you how that data affects the market. Now, this is an interest rate chart that covers this, that spans the time from 1950 to 2007. As you can see here on the side, this is the interest rate itself going up the left-hand side, and here at the bottom is the year in question. This chart begins at just before 1970, say about 1971 on this chart, and the interest rate there was a roughly 7.25%, about 7.5%. In the early 70s, it went up pretty sharply in a very short period of time. As you can see, over 2 years, just a short period of time here from 72 to 74, it went up 2 points, 2 full points in interest rate. This was also the period that coincided with the oil embargo. This was the first big oil embargo that we had in the 1970s, and gasoline went from around 25 cents a gallon up to first around 50 cents, and then almost $1 a gallon, shot up very quickly in a short period of time, and the corresponding impact on interest rates was dramatic. They went down for just a while there again in the 70s, and then as you can see, about the time the Carter administration started in the late 70s, they shot up dramatically to, look at that, 16.5%. So don't be fooled into thinking that interest rates are always low. Just because we have very low interest rates today doesn't mean that you can't see a dramatic change in a short period of time. Again, let's look at this closely. We had about 7.5% in 1972, and by 1981, only 9 years later, we were at almost 17%. I'm here to tell you that if you have an interest rate change like that quickly, you are going to have to change your investing strategy. So what happened here? When these interest rates got up this high, all of a sudden it was very difficult for the majority of buyers to qualify for a new mortgage. So what had been a typical normal real estate market right in here until all this happened, by the time you get to right here, the fundamentals have changed so drastically that what actually happened was people began to take over existing mortgages. That suddenly became much more common than it had ever been before, because we had a lot of owners who had properties that were financed in the 1960s at 5-6%, And then all of a sudden, when they get ready to sell, they're looking at 17% interest rates, so the buyers wanted to take over those existing mortgages because they were cheaper. At this point in time, creative investment strategies became very popular because these interest rates, as you can see throughout the entire 1980s, these rates, even though they did start to come down, they remained very high relative to what they had been in the years previous. So here we are near the end of, let's see, that is 1986 and 1987, and we're still at 10%. So for 10 years, we had double-digit interest rates. So this is something that really spawned what we think of today as the creative real estate market. It was this particular period of time right here when interest rates were so high. Now, the folks who were involved in those creative strategies designed around high interest rates didn't pay a lot of attention when the rates started to come down. By the early 1990s, we had another major real estate market crash right in here. And that crash, as you can see, caused interest rates to drop rather quickly at this point. So by 1993, interest rates were back down at that 7.5% level. What happened right there? Okay, everybody that had been using creative strategies based on high interest rates here suddenly found themselves going bankrupt when interest rates dropped here. One of the most famous cases of that was Robert Allen, whose book Creating Wealth was one of the most famous bestsellers of the 1980s during the high interest rate period because it was based on creating notes that basically revolved and worked because of the high interest rate environment. When interest rates dropped, nobody wanted to use that strategy anymore, so Mr. Allen found himself holding properties that would no longer cash flow, would no longer sell, and he wound up in bankruptcy by 1996. So the point here is that the fundamentals, real interest rates are a huge fundamental. When they change and change quickly, it drastically impacts your choice of strategy. Now, if you're on the right side of that market, you have holding properties with low interest rates as we have today. Here we are at 2007 on this chart, but we know that interest rates are even lower than that today. In fact, that's at 6.5 roughly. And today we're actually down in this range right here for the people with the best credit. They're actually way below where we were at in 07. So if you're buying property today and financing at these low interest rates on a fixed rate mortgage, if interest rates do shoot up again, you'll be in a good position. But when you build strategies around high interest rates and then interest rates come down, you can be in serious trouble in a fairly short period of time. So interest rates are a huge fundamental issue that it's very important to pay a lot of attention to. And going forward, I don't know how much longer we're going to be able to maintain the low interest rates that we've got today because of the federal debt. There's several big issues that can influence the movement of interest rates, and it's anybody's guess as to how much longer we'll have interest rates this low. Once they do start to move up, depending on what the trigger factors are for that, they could go up in the near future over the next few years just as quickly as they did right here, and that would again drastically alter everybody's buying and selling strategy. So it's important to keep an eye on interest rates and an eye on what's going on behind the scenes that can cause those interest rates to shoot up quickly. The next item we're going to talk about here is unemployment. This is an actual chart from the Georgia Department of Labor for the Atlanta metropolitan area, and it was added and compiled in March of 2011. We're not too much below this now. We've edged down to around maybe 8.5%, somewhere in there. So we're a little bit better in Metro Atlanta today in 2012 than we were a year ago when this chart was taken. When when unemployment rates are high, obviously it impacts buyers because there's fewer buyers in the market that can buy houses. So these high unemployment rates suggest the obvious here. Atlanta has high unemployment, and that's resulting in fewer home sales. So what we're seeing is a transition, a big transition in the Atlanta market from home owners to home renters, and a very high rate of foreclosure relative to historic levels. Unemployment is a function of specific markets. So while the Atlanta market has relatively high unemployment, there are actually markets in Georgia that are doing very well. And generally speaking, right now, for any part of the nation, you'll find that your best employment rates are found locally in areas that have the highest concentrations of medical facilities like large hospitals, colleges, universities, and government facilities. So in Georgia, in towns that have a big college, a big medical facility, and government facilities all located in the same general area, unemployment tends to be much lower in that specific city than is indicated on this chart for Metro Atlanta. And that pretty much holds true for every part of the country here in the spring of 2012. The three fastest growing employment sectors at the moment are government, in particular federal government, medical facilities, hospitals, and educational facilities, colleges and universities. So if you're located near one of those three sectors, there's a good chance that your employment rate is significantly lower than what we see here in Metro Atlanta, which happen to be more heavily dependent on construction and service industries that suffered when the recession started. Next, we're going to look at some home sales data. These charts were compiled by the National Association of Realtors, and this particular chart spans March of 2011 here on the far right, going back to early 2007. So what we're seeing is this downward trend actually began in home sales, began prior to March of 2007. Really, it was in 2006, not shown quite here, but coming downward. Began to level out a little bit. This is where everybody sort of started arguing about whether or not the housing market was about to tank. And of course, by late 2008, here we are this is where the credit crisis actually happened right here. And so we bottomed out. And this, as you can see, this is very low, even though this is millions of sales. So we essentially dropped from 6.5 million sales at the peak to 4.5 million sales in about 2 years' time. So that was a pretty drastic change in the housing market. And then right here we see it going back up, and this is actually signaling the beginning of the period that was where the buyer tax credit actually took place. There's a lot of data that correlates to show that the tax credit that was implemented by the government at the time of the early days of the housing crisis actually did a tremendous amount of good to improve home sales. But the minute that tax credit expired, the market went right back into a funk and has not really ever recovered from that. As you can see, this peak level here in 2009 started dropping as the credit ran out. And after that tax credit ran out, it bumped along a little bit better there for a while, and then it really took a nosedive after that credit expired in the summer of 2010. It expired completely. And so the market just went down, 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 and has improved somewhat, but as you can see, this is still way off of the original peak levels. And so we have pretty much found a bottom right in this area. So we're sort of going along here at a rate that's been fairly stable, with the only real peaks being related to that buyer tax credit. And here's another chart that kind of shows that same point about the buyer tax credit. The increases here, this is March of 2010 through March of 2011, a one-year period. And these numbers reflect increases in home sales activity. And this was, again, the last few months of the buyer tax credit. The credit expired right in here. You had to have the property under contract, I think, by the 1st of July of that year, if I recall correctly. Once that contract period ended, the bottom fell out of the market again because that incentive was gone. And so the rest of 2010 saw lagging housing sales actually got worse as time went on during the year. And the later in the year, that's a seasonal thing also. So we not only saw that decrease as a result of the expiration of the tax credit, but we also see a decrease in home sales relative to wintertime. As you move into wintertime, sales always get worse, even in a good year. And as you move into spring and summer, just like right now, we're in the spring of 2012, everybody's talking about how the housing market's improving. Well, that's the normal seasonal activity kicking in there. Same thing, we saw a little improvement in early 2011, and then again, just pretty much dragging along as we went through 2011. So there's no question that fundamental things like taxes, for example, can impact the market. A tax credit had a very positive impact on the market, but it was very short-lived. And now the market went back to basically, it's not quite as bad, but still not good, not growing relative to what we had seen in the past. And here's the correlation with pricing. As sales go down and drag down, pricing goes with it. And here we see median prices in 2007, just after the peak of the market, beginning to trend downward pretty steadily. As you can see, you have little bumps along the way where for a given month or two, that's why housing data really doesn't mean much on a month-to-month basis. You have to look at the long-term trend over the entire year, because you'll always have months, no matter what the market is doing, where the data appears to be getting better. This is one example right here in November of 2007, where it appeared that the data might actually tick up, but instead it dropped down drastically in early 2008. And then right here in the summer, again, this is your seasonal pickup right here, May, June and July period, right in here where it ticked up. And then as we got to the end of the summer, we started to see that steady downward trend that became right in here, became the credit crisis, occurred right in this area here. And of course it went on down the rest of the way for 2008 into early 2009. And then this uptick again were those attempts to institute the buyer tax credit. This one little peak we had right here was the end of the buyer tax credit again, and then trending downward again since that time. So you see a little upward tick here, but this was early 2011. We know now that that really didn't mean much. It was pretty much just a curve and continued on downward from there. Alright, so this, again, another chart demonstrating home sales median average prices year over year. And this is what you see, as home sales ticked downward, prices went with it. Because again, the demand for housing, a fundamental issue is demand. The demand became less, the supply became greater, and therefore, generally speaking, and for the majority of the country, the prices fell. Again, this is still market-to-market relative, because not all markets fall in price or fall as much. Atlanta has seen a roughly 35% decrease in prices since the peak in 2006, where Washington, D.C., Arlington, Virginia, those areas where you have government, educational facilities, hospitals and so forth, and all in a close area, they've probably lost some value, at least in the early stages of the housing crisis, but not nearly, probably nothing approaching 35%. Now here's some interesting data for you. This is a chart of sales prices by price range. I'm sorry, sales numbers by price range. So you can see the vast majority of the sales of homes occur in the lowest price range. 100 to 250,000 is 43% of the market, and again this was in 2011. 27% of the this is really the junker category here. In most areas, if you get below 100,000, the house is in pretty, generally needs some repair. Not all houses are that low, but if you're even in the Atlanta market, where things are probably one of the lowest priced of any market in the country, a property below $50,000 is generally going to be in pretty junky condition, no matter what part of town you're looking at. And these are generally your investor buyers. And these are going to be a combination of investor and first-time owner-occupant buyers, the majority. These are generally going to be your move-up buyers, and so on and so forth. So one of the key things that we're seeing today is that home sales are being heavily driven by cash sales, predominantly to investors, but not all investors. But as you can see, this chart, roughly almost 3/4 of the entire housing market sales are either going to be investor buyers or first-time buyers just by virtue of the price range itself. Remember, knowing your market fundamentals helps you avoid unpleasant surprises. So if you bought a new home or a shopping center in 2006, then from your perspective, the market's probably bad today because you owe more than that property's worth. But if you were a smart investor and aware of the market fundamentals when the market became overpriced in 2004, 2005, 2006, and you waited for those prices to come down, you're seeing a great market right now because you're seeing some of the best buying opportunities that have been available in years. So it's never really a question. The market's always both good and bad. It depends on your knowledge of the fundamentals and how you use that knowledge of the fundamentals in your investing strategy. And everybody is an investor because nobody buys a house with the intention of losing money on it, or any property for that matter. So in my mind, everyone that wants to own a home to live in or a home to invest is a real estate investor, and it pays to understand what's going on with the fundamentals in the market, regardless of whether you want a house for investment or a house to live in. Thanks for joining me today and watching this video. I am the Director of Realty Biz Consulting. We provide education, training, and coaching for beginner and advanced real estate investors, and we also provide opportunities to purchase investment properties. You can join our email list and get more information at realtybizconsulting.com. And here's some other contact info for us. And thanks for joining us today. Check out the other videos, and remember, if you are looking for high quality coaching from folks who are not merely real estate coaches, but people like myself who are actually in the industry, who make their living in the real estate industry, they don't sit in a call center and coach people on the phone as professional coaches. We actually use coaches, only coaches, who are professionals in the real estate industry, investors, attorneys, real estate brokers, real estate appraisers, property inspectors. All of the people that we use in our consulting programs are in the business and generally have at least 10 to 15 years of real estate experience. So if you're considering a high quality coaching program, you're looking for investment properties, we offer programs for all levels of real estate investors, whether you're a beginner with a very low budget or an advanced professional that needs highly advanced business coaching to expand an existing investing business. Realty Biz Consulting is the sensible alternative where you can get professional help from real estate investors and industry professionals. I'm Donna Robinson. Thanks for watching.